Welcome to This Explainer. We're jumping right in today because we are embarking on an incredible journey into the irresistible, and honestly sometimes fatal, allure of borrowed money. Throughout financial history, debt has essentially been the rocket fuel behind some of the absolute greatest corporate triumphs. But on the flip side, it's also the root cause of the most spectacular market meltdowns we've ever seen. So we're going to break down exactly how this mathematical game of risk and reward actually works. All right, let's dive into this.
Now, I want you to imagine, just for a second, controlling a staggering $125 billion in wealth. Pretty wild, right? Okay, now imagine that only a tiny, tiny fraction of that money is actually yours. And the rest? Well, it belongs to the world's biggest banks. What happens when the market suddenly turns against you? Look, this isn't just some hypothetical what-if scenario. This is a very real historical event that literally almost brought the entire global financial system to its knees. But before we get to that dramatic story, we really need to understand the underlying mechanics at play here.
At its absolute core, financial leverage is an amplifier, and the math behind it is beautifully simple. It's just total liabilities divided by total equity. Think of it kind of like a massive financial magnifying glass. When times are good and your investments are yielding higher returns than the interest you're paying on your debt, leverage magnificently amplifies your profit margin. It creates massive shareholder value. But, and this is a huge but, if returns fall or if interest rates spike, that exact same amplifier goes into reverse, and it can drive you toward completely devastating value destruction.
So, you might be wondering, why take the risk at all? Why are businesses so deeply tempted to pile on debt instead of just playing it safe and using their own saved equity? Well, according to the pecking order theory of corporate finance, companies actually do prefer using their own funds first. But when they need external capital to grow, they overwhelmingly reach for debt before they ever issue new shares. Debt, quite simply, allows a company to fund massive projects that would otherwise be completely impossible. Plus, it's often cheaper, and it prevents the original business owners from having to dilute their ownership by selling off their shares.
Now, academics have actually wrestled with this temptation for decades. Back in 1958, there was this famous Modigliani-Miller theorem, and it boldly claimed that in an idealized perfect market, meaning zero taxes and zero bankruptcy costs, a company's debt-to-equity ratio doesn't matter at all to its overall worth. Basically, it's irrelevant. But let's contrast that with the traditional view. Before 1958, finance textbooks taught that a firm's cost of capital was actually a U-shaped curve. Because debt was initially cheaper than equity, taking on leverage lowered your overall costs. But eventually, if you borrow too much, investors are going to demand higher returns to compensate for the growing risk of bankruptcy, which drives costs right back up.
And that dynamic builds directly into what's known as the classic trade-off theory. Think of this like a giant balancing scale. Over on one side, you've got the massive advantage of tax savings. When a company borrows money, the interest payments are usually deducted from taxable income. This wonderfully lowers their tax bill and boosts their profits. But on the other side of the scale sits bankruptcy risk. As you pile on more and more debt to grab those juicy tax shields, the risk of financial distress just gets heavier and heavier. So, the ultimate goal of corporate finance? Finding that perfectly optimal balance.
But here's the thing. Perfect mathematical balances rarely survive the absolute chaos of real-world markets. When volatility hits, that pretty math breaks down fast. Suddenly, you're facing the unrelenting pressure of debt service. And those fixed payments? They do not care if your revenue has completely dried up. A sudden downturn can instantly trigger insolvency. Or consider loan covenants. If your company's performance dips, a covenant breach might allow the lender to just demand immediate repayment. That ongoing interest expense starts eating right into net income. And ultimately, owners run the very real risk of losing the business assets they pledged as collateral.
Which brings us to a genuinely terrifying scenario, known in finance as debt overhang. When asset values start to fall, a highly leveraged firm sees its already thin slice of equity shrink rapidly. Normally, in a crisis, you try to raise new equity to survive the storm, right? But when a firm is deeply in trouble, raising new equity becomes virtually impossible. New investors won't touch the company with a 10-foot pole. They know full well that their fresh cash will just go straight to paying off angry creditors, rather than driving any actual growth. The firm essentially becomes completely trapped.
And this is where it creates a terrifying systemic danger for all of us. When a trapped, over-leveraged institution can't raise new capital, they only have one terrible option left on the table: forced asset sales. They basically have to liquidate their holdings immediately, often at fire sale prices, just to pay down their debt. This aggressive, desperate selling pushes overall market prices down even further. That, in turn, shrinks the equity of other totally unrelated firms in the market, who are then also forced to sell. It creates this brutal, positive feedback loop that destabilizes the entire financial system. So to truly understand the destructive power of this cycle,
We have to look at the ultimate cautionary tale, long-term capital management, or LTCM for short. Launched back in 1994 with a staggering $1.25 billion, this fund was run by a Wall Street dream team. We're talking brilliant minds and literal Nobel laureates. By 1996, they were pivoting heavily into complex derivative swaps, executing what they fully believed were low-risk arbitrage trades. Basically, they hunted for tiny, almost invisible price discrepancies between related assets, betting that those prices would eventually converge. But in 1998, an unexpected shock hit the market, bringing the entire mighty structure completely crashing down.
So how exactly did a fund run by certified geniuses fail so spectacularly? Well, the answer comes down to a really reckless ratio, 25-1. Because their super complex mathematical models told them their trades were virtually risk-free, they leveraged their results to an absolute extreme. They built a massive balance sheet holding $125 billion in assets, but their actual equity cushion, a mere $5 billion. Think about that for a second. They were controlling a massive financial empire with barely a sliver of their own actual money.
And incredibly, the sheer scale of their exposure was even more terrifying than that. Beyond their official balance sheet, LTCM held an estimated $1 trillion, yes, trillion with a T, in over-the-counter derivatives. Let that sink in. For every single dollar in equity they had, they held positions of $200 or more in derivatives. And because the OTC market at the time was completely unregulated and opaque, neither their trading counterparties nor federal regulators had any idea just how massive and precarious LTCM's positions truly were. It was basically a ticking time bomb.
The tipping point finally arrived in the summer of 1998. The Russian government shockingly defaulted on its bonds, and global markets absolutely panicked. Investors fled from anything deemed even slightly risky and flooded straight into the absolute safety of U.S. Treasury bonds. Now, LTCM had bet heavily that the prices of different global bonds would converge over time, but because of this massive panic, the prices violently diverged instead. Their supposedly brilliant, foolproof mathematical formula completely failed them. Almost overnight, LTCM faced devastating losses and had virtually zero capital in reserve to satisfy their angry lenders.
Remember that systemic positive feedback loop we explored just a bit earlier? Well, this is exactly where the theory became a living nightmare. LTCM was hit with massive margin calls and was forced to hastily liquidate its positions. But here is the crazy twist. Because LTCM had historically been so incredibly successful, other Wall Street firms had basically copied their exact portfolio. This phenomenon is called herding. So when LTCM was forced to sell off assets, these copycat firms were forced to sell the exact same assets at the exact same time. Suddenly, completely unrelated markets were crashing in unison. The contagion was spreading like wildfire.
The failure of LTCM wasn't just going to wipe out one single unlucky hedge fund. It legitimately threatened to drag down the behemoths, commercial and investment banks of America, Europe, and Asia. It was the classic setup for a massive market run where nobody knew who would get burned next. The systemic risk was so severe that the Federal Reserve had to actually step in. They urgently orchestrated a massive rescue, bringing together 16 giant rival financial institutions, everyone from Goldman Sachs to Barclays. They had to inject cash and carefully, piece by piece, unwind LTCM's toxic, highly leveraged portfolio, all just to prevent a complete global financial standstill. The scary part is, history seems trapped in this chilling cycle of leverage and panic. LTCM really wasn't an anomaly. Think back to 1929. It was individual investors forced to sell stocks to meet margin calls. Then in 1998, we just saw the forced sale of arbitrage portfolios by highly levered hedge funds. And exactly a decade later, in 2008, we saw the exact same dynamic play out all over again, with investment banks forced into fire sales of mortgage assets. In every single one of these cases, when asset values drop, highly leveraged players are forced to sell, causing a highly correlated, devastating market collapse. So the obvious question we have to ask is, how on earth do we stop this from happening again? Well, following the devastating destruction of the 2007 to 2009 financial crisis, global regulators finally woke up. They realized that relying on complex, internal risk-based formulas just wasn't cutting it anymore. Firms were entirely too good at hiding their true leverage in off-balance sheet exposures, literally exactly like LTCM did back in '98. The financial system desperately needed a hard, simple, unbreakable rule to act as a definitive safety net against these devastating periods of forced deleveraging. Enter the regulatory response, the Basel III minimum leverage ratio. It's a firm, totally non-negotiable 3% backstop. And the math here is intentionally simple. It's just your capital measure, specifically high-quality Tier 1 capital,
divided by your total exposure measure. And crucially, that exposure includes both on- and off-balance sheet items. It is completely non-risk-based. Regulators are essentially drawing a hard line in the sand. They're saying, look, we don't care how incredibly safe your internal models say your trades are. You absolutely must maintain a strict baseline of actual equity to absorb unexpected shocks.
Which leads us to our final thought for today's explainer. We've defined the amplifying power of leverage, we've explored that really delicate trade-off between tax shields and bankruptcy, we've witnessed the trillion-dollar collapse of LTCM, and we've unpacked the regulatory safety nets built in response. But as we've seen time and time again throughout financial history, human nature absolutely loves the magnificent sky-high returns that borrowed money can provide. So I'll leave you with this. When the next totally unseen crisis inevitably hits, will a simple 3% backstop truly be enough to stop the dominoes from falling? Thank you so much for exploring this fascinating topic with me.